Hello there everyone, this is Howie, and before I get started I want to talk about these sunglasses. They are pretty awesome. It's sunny today and I wore my contacts, so I can't put my slip-on over the sunglasses. So these are my daughter's and they're quite lovely, if I do say so myself. They even have some sparkles on the side. So anyway, today I was actually thinking of making a little video about something that I've been struggling with the last 2 or 3 days on the market, and that is purchase order versus market order. Sort of setting a stop or setting a limit order, not a stop, but a limit order when you're buying a stock versus just buying it at market. I've read a fair amount on both. There's pros and cons to both. I guess I'll do a brief explanation for y'all, just sort of like a beginner's lesson if you don't understand. So if you're just sort of getting into it. So let's say you have stock ABC, and that stock is currently selling for $10. So what that means is there are people on the market that are willing to sell that stock for $10. But generally speaking, what that also means is the top amount of dollars that people are willing to buy that stock is usually a penny below that. So maybe there is 1,000 shares available at $10, and there is 500 shares of people wanting to buy at $9.99. Well, as soon as someone either says, okay, I'm willing to sell at $9.99, then, or someone says I'm willing to pay $10, then the $10 stock will get sold, or the $9.99 stock will get, the $10 stock will get sold, or someone will sell at $9.99. So that's sort of where you have this difference in share prices, the ask versus the bid. And normally they're within a penny. On some stocks, there can be several cents, up to 10 or even 15 cents between these two. And this is called the spread. So the spread is just a difference. So to give you that same example, let's say the most someone is willing to pay for a share is $9.95, but the most someone is willing to sell that same share for is $10. So then you have a 5-cent spread. So if you go in the stock market and you want to buy a bunch of shares of something, you have two choices. You can put in a market order. And what that means is that regardless of the asking price, I got tilted there, better. Regardless of the asking price, you are going to buy all of your shares at the lowest possible price. So that means in the example we were using initially, you were going to buy them at $10, even though at the time the most someone was willing to pay was $9.99. You put it in the market, it'll buy it at the lowest price, which is $10. Now, the concern that some people have with this, if you're buying a large volume, it's possible, let's say the stock is valued at $10 in the example, that there's only 100 shares being sold at $10, and then there's 200 shares that are being sold at $10 and a penny, and then there's 500 shares that are being sold at $2.02. Well, what that means is if you wanted to buy 6,000 shares, it would buy all of them up at $10, and then buy all of them up at $10.01, and then buy all the rest at $10.02. So your average purchase price might be $10.01, or $10.01 and a little bit, or something like that. Whereas if the other way to purchase a stock is to put it at a limit order, which is basically where you are going to set the price that you're willing to pay and only purchase if the stock is available for that price. So you might put a limit order of $9.99 in this example, and basically you will not buy unless there is stock available at that $9.99. So that limit order could sit there for 10 seconds, for 10 minutes, or even for days. I've had limit orders that have sat for a week and not got filled because the stock, there's no one willing to sell at that price. So one advantage of limit orders is you're never going to overpay. You're always going to pay what you want to pay for that stock. But a significant disadvantage, in my opinion, is that you may not get that order filled. So that means you may not buy that stock at all. And if you see a stock you think is at a good price, has a good value in your opinion, and then you put that limit order in and it doesn't fill, it's quite disheartening. The reason I'm talking about this as an example is over the last 4 days, I've had no less than 5 stocks where I saw it as good value, but I put a limit order in to protect myself, and none of them, I shouldn't say none of them, 2 out of 5 got filled, and 1 got filled about a third of the way before the stock rose up, and it got higher than my limit order. And all 5 of those stocks, at least currently, have all gone significantly up between, say 3 and 10% versus where I had my limit order at. So in those examples, because I tried to play it safe, I ended up not even getting the purchase. So again, this isn't black and white. This is, some people will say if you're a beginner, you always want to only use limit orders so that it protects yourself. And most day traders just use market orders for both buying and selling because they want in and out quickly. And if you want speed, you want to buy at that immediate second, then you're going to do a market order. So just good food for thought. If you have an opinion on this, I'd love to hear your opinion. And I can respond in the chat down below, in the comments down below, as they say. And I hope you enjoyed this video. I look forward to making many more. See ya!